Hey everyone, thanks for tuning in to our January 2026 Investment Committee Update. I'm Chad Smith, a managing partner at Reveille Wealth Management and part of our investment committee. Today, Stephen Weitzel and I are going to share our latest market perspectives and how we use our rules-based investment discipline to inform the current positioning within our investment strategies. Now, despite the alleged disappearance of Santa Claus, markets started 2026 very strongly. A pronounced rotation away from the former market leaders is evident and has been showing signs of strengthening of late. January exhibited strength in small and mid-cap stocks, value-oriented stocks, dividend-paying stocks, and we saw continued relative strength from international stocks. Extremes in the concentration of ownership and valuation levels in large-cap U.S. growth stocks continues to be present and poses both a risk and opportunity in the market, which dictates the need for adapting to a changing market environment. Private credit problems have also been persisting, with further evidence recently building that dangers lay beneath the surface and should not be ignored. President Trump has nominated Kevin Warsh to succeed Jerome Powell as the Federal Reserve Chairman, thus removing an uncertainty that has been overhanging the market. Now, while the market environment remains constructive and longer-term uptrends are prevailing, we do caution that the road ahead may be a bit more volatile this year, as we are in a midterm election year and other uncertainties, of course, are out there from a global perspective. And with that, I will turn it over to Stephen to walk us through this month's review.
Okay, thank you, Chad. So let's jump in here. And we're going to start our review off today with a word of caution. And this isn't a new word of caution because we have been talking about it for a while. In this case, being the concentration risk that underlies the large U.S. stock market indexes today. So this chart may look familiar to you because we saw it in last month's review as well. The S&P 500 index has never been less diversified than it is today. The 10 largest components within the index account for more than 40% of the total market capitalization of this index. That's nearly twice the size or more compared to historical standards. 8 of the 10 largest companies in the S&P 500 index today also happen to be technology stocks, which fall under the growth classification, whereas the other 2 of those largest 10 stocks are both financial companies, which are classified as value. And while over the long term, large cap stocks, whether they're growth or value, are likely to experience similar outcomes, historical cycles do exist where one classification of stocks is going to outperform the other, and oftentimes it's by fairly large amounts. For example, growth stocks outperformed their value counterparts significantly starting in the mid-1990s until the peak of the dot-com bubble in early 2000. And as the tech bubble imploded, value stocks such as consumer staples, banks, industrials, and energy companies, they became market leaders, and they meaningfully outperformed their growth counterparts until the housing market peaked in 2007. So when we look at this chart here that compares the Russell 1000 growth and the Russell 1000 value, when this chart is moving down, this is the growth stocks underperforming. This is value stocks outperforming. Conversely, when this chart moves higher, this is growth stocks outperforming, value stocks underperforming. Okay? So since the peak of the financial crisis, growth stocks have experienced perhaps one of their longest periods of outperformance in history, closing in on 20 years, although not without some interruption along the way. Well, that brings us to today, where we find this ratio between growth and value indexes trading up to a level where we might expect it to encounter some resistance, and that is exactly what's been happening since late 2025. herein lies the concern. If the largest components of the U.S. stock market are comprised almost entirely by the growth stocks, and those components make up more of the index than ever before, and those cohorts of stocks are starting to underperform, what should we prepare ourselves for? Well, we don't want to make any predictions here. However, in two prior instances where we saw this ratio reverse from 2000 to about 2002, and then from late 2021 into early 2023, that's when we saw some meaningful pullbacks in this ratio. Those were not periods that we would classify as bull markets. Quite the opposite, in fact. So we do need to be somewhat guarded if we start to see this pullback become more pronounced, that it could lead to deeper problems at the index level. Now, lastly, when we start to see an asset class struggle, we tend to see them struggle against a number of their alternatives. So should we be surprised then to see the S&P 500, which is highly concentrated in these tech names that are trading near the highest valuation levels that they've ever traded to on a historical basis, should we be surprised to see the S&P starting to underperform a growing number of alternative asset classes? I don't think we should be. I think the bigger surprise when they end up writing the book on this cycle is we're going to look back and say, I'm surprised that it went on for as long as it did. Now, somewhat in keeping with the frothy valuations and concerns that we have around the sustainability of the AI technology build-out, which we've been discussing at length for the past few months. If you've missed it, check out our YouTube channel. Make sure you're subscribed there. Turn on your notifications so you get alerted as soon as we post commentary on there. But the private credit market is potentially the most underappreciated risk in today's market. In one of our recent podcasts, we discussed how the difference between a mania and a bubble is that while both experience significant rallies and declines in the stock market, bubbles are different to the extent that in those circumstances, even the bondholders will face meaningful losses. People who didn't anticipate putting their capital at risk of reasonable decline, they too take it on the chin. And so we've spoken in the past about how this private credit boom has been similar to the abundance of mortgage financing prior to the financial crisis, where underwriting standards were quite lax. Well, that's not the case anymore for the banks that now face a lot of regulation post-financial crisis, but this type of lending that used to be done in the banks has now been pushed into the private markets, where these funds are given money, they pool money from investors, and then they're obligated to lend it out. And perhaps they're not overly discerning about who they lend it to. So in late January, a story hit the Bloomberg wires where Apollo, who's one of the largest players in the private credit alternative investment space, they took a loss of $170 million on a $500 million investment that they had made. That's a 34% loss for everybody at home. And what's somewhat stunning was the headline that accompanied that and admitted that this loss was taken on something that they had deemed safe. And so I worry that there are currently tens of billions of dollars of masked losses currently in the private credit markets. A lot of this money has been used to finance the AI build-out. And if the build-out just doesn't come to fruition the way that it's been hyped up as of right now, there could potentially be many investors in this private credit space that end up with meaningful losses, and those folks never really intended to be taking lots of risk with their capital. And those are the things that happen when bad situations become much worse and have much longer and deeper impacts. So, if you're currently invested in these private credit funds, I would tread very cautiously. Believe none of what you hear and only half of what you see, because as our friend Larry McDonald likes to say, the truth bleeds out very slowly. Now, let's move on here. We are at the onset of year 2 of the 4-year presidential cycle. So this year historically is the choppiest of the 4 years. But we need to recall that we are still in the middle of the most bullish 6 months of the year. So from November through the end of April, that's the most bullish 6 months of the calendar year. And then you sell in May and go away. Well, that historical analog, it actually tracks really well for year 2 of the presidential cycle, where it typically peaks there in and around May and then sells off going through the summer into the early fall. And then the rally from fall of year 2 into the middle of the pre-election cycle is typically quite strong. So, but will this year's market actually follow this analog, right? To be determined. And we never want to blindly follow seasonal or historical trends. We want to follow and align ourselves with actual market trends. But we should probably file away in our minds after such a strong start to 2026 that it's probably not going to be quite that good every month. All right, so we're going to move on here and we're going to start to look at some charts of these key asset classes, and we're going to begin with large cap US stocks, S&P 500 as our proxy here. Still in an uptrend after that sell-off back in Liberation Day, April of last year. After we got back into an uptrend in May of last year, we've been moving steadily higher. The S&P was up 1.37% in the month of January, but that was one of the weakest returns that we saw in the equity market, right? As we've discussed in the first part of the review here today, the S&P has grown ever more concentrated in the large cap growth names over the last decade, which made it the leadership group in the market. But those times, they really seem to be changing. The concern is going to become that if this category turns into a broad laggard and it underperforms on a relative basis compared to essentially every other asset class, if that happens, will that result in poor performance on an absolute basis as well? Meaning, if it's going to underperform everything, is it actually going to have enough money withdrawn from it where it goes down in value too? Check out this conversation I had recently on our weekly YouTube show, The $1 Million Question, where my friend Larry McDonald joined me for a discussion about the risk that he is attuned to in today's market. You can find the entire episode on the Stock Market Media YouTube channel. Take a listen to this.
We recommended the COPX in the book. The book's published in 2024. COPX is up 114% year over year. It's a basket of copper names. But on the other side of the coin, there's 32 trillion in the NASDAQ 100, maybe almost 33. So 33 trillion in the NASDAQ 100. And it's crowded into all these idiotic, moronic AI stocks, right? That are priced for 820.
Absolute perfection.
Well, yeah, you need 820 data centers to be built in 5 years without any problems with the power grid, without any problems with NIMBY, not in my backyard. I can name 20 other things. And so if that build out just goes from 820 data centers to 600, then a good portion of the S&P is probably going to drop 50%. And once again, you want to be in a portfolio, and you just look at it since October. The market's starting to smell this out.
So we need to be concerned that if expectations are too high in today's market, that there could really be some downside in front of investors, we need to make sure that we're guarded against that. Now let's move on. We're going to look at mid-cap U.S. stocks. We notice that they too remain in an uptrend, had a strong January, up over 4% to start the year. And importantly, this area of the market had struggled since late 2024, where they peaked shortly after the election, right? And had just been grinding sideways ever since then. But we recently eclipsed those former highs, which is a really welcome sign for the bulls. Small caps, the Russell 2000 index, also remains in an uptrend, closed January at a new all-time monthly closing high. This after 4 years or so of no progress. The Russell 2000 had previously peaked out in October of 2021 and was unable to break above those former highs until December of last year. So we said in last month's review that this breakout could be a massive development. And as for now, it appears that that breakout is not only holding, but that this train may be leaving the station. Russell 2000 index up nearly 5.5% in January. Very strong, and it's about time. Hasn't done anything in 4 years or more. Now, when we look at small cap stocks on a relative basis versus their large cap counterparts, we see them potentially finding support at a logical level. And that's the level where they essentially bottomed at the peak of the dot-com bubble, right? It was at this level 25, 26 years ago when small cap stocks stopped lagging and became the leaders. So is it merely a coincidence that they've started outperforming their large cap counterparts at these same levels? So the $1 million question as to what's causing small caps to bottom relative to the S&P now? Well, first off, and we discussed this in our Bugle Notes podcast in December, the Are We in an AI bubble discussion. And we drew these parallels to the dot-com bubble, to that internet revolution. And that was the last time when small cap stocks underperformed large caps, in particular the large cap growth stocks, by such a meaningful amount. That was the last time when we saw this major technological revolution with the proliferation of the internet, computers, and software. And early on, that technology was very expensive, and it was only the largest companies that could afford it and implement it into their businesses. Smaller companies were left behind until the technology became a commodity, and it faced obsolescence within a few years. And so the cost of that technology fell dramatically to the point where essentially every company, large or small, could afford it. So even if the technology was several years old at that point, small companies could acquire it cheaply, and even if they were just going to go from 0 to 25 miles per hour, it was still a market improvement for them. So they could benefit from that technology once it became cheap enough for them to afford it. Second, and this is really more of like a chicken or the egg type of a scenario. So as we just saw, we now have the small cap index, the Russell 2000. It's breaking out to new highs after making no progress for several years. And so we saw that on the last slide. So that now creates some technical support for the asset class. We've seen the same thing with the international stocks over the last 8 or 9 months, and we're going to look at that here momentarily. But perhaps the small cap stocks, they have money coming into them now, right? Because they do have that technical support of breaking out, but also now they are as cheap compared to the large cap stocks as they've been since the peak of the dot-com bubble. So maybe that is why they've got money rotating into them. Either way, here's the great news. It doesn't really matter what is driving the move into small caps. The only thing that matters is that we've identified that small cap stocks are in an uptrend and that we believe that investors need to be allocated to them in their portfolio. Until that changes, full steam ahead. Now, just reference the international stocks. So here we are looking at the Developed International Index. So what a ride this has been. One of the strongest advances we've seen in developed international stocks in many, many years. And until late spring of last year, this was an asset class that had made zero appreciable advance since late 2007. Over 18 years of no gains. But we were watching those former highs, right, and expecting that once we could eclipse them, that there would be plenty of upside ahead. And that was a historic breakout. And this remains one of the strongest asset classes in the market, up almost 5% in the month of January alone. Emerging markets, they also had a very strong 2025, despite all of the tariff and trade war concerns. Same thing for the international developed markets. We talked a lot about that, how investors were concerned about tariffs and trade wars, and maybe we shouldn't own it. And it turned out, once again, just like it was in 2017 when they were concerned about it first time around with the Trump administration, we got to get out of international stocks, and maybe they didn't have the nefarious impact on those markets that we expected and turned out to be leaders, right? So for the emerging market index, just like unlike what we've seen in developed international and the Russell 2000, this one had yet to break out above those former highs until January, right? So the question is now, is this one going to follow the same path as the developed international stocks and continue to pull further away from these 2007 highs? We don't know for sure. All we do know is that this asset class is in an uptrend, and investors need to align themselves with that trend, and you need emerging markets in your portfolio. We're going to move on to bonds. U.S. Aggregate Bond Index, it too remains in an uptrend. It has been a good environment for bonds, but it seems like 2026 could have a large move in store. So with Kevin Warsh recently announced as the incoming chairman of the Federal Reserve, he's likely to be confirmed in Congress. But many people have been expecting that the Trump administration is going to appoint somebody to this role that will prioritize further interest rate cuts. But I'm not convinced that that's actually going to unfold, and I'll tell you why. The yields on the 12-month U.S. Treasury bill and the 2-year U.S. Treasury note are some of the best forecasts that we have as to the future direction of Fed policy. We spoke about that last month, where we showed how yields in the bond market moves along the U.S. Treasury curve. They're effectively either unchanged or have even risen since the Fed first began lowering rates in September of 2024. So even though the Fed has lowered rates 6 times, the yield on the 12-month bill and the 2-year U.S. Treasury have not moved much. The yield on the 10-year U.S. Treasury, which has more direct impacts on mortgage rates and small business loans, it's actually risen by over 0.5% during that same time period. I'm concerned that Mr. Warsh is going to be somewhat hamstrung in his efforts to lower rates much further, if he even desires to do so. Right? Do keep in mind that he did previously serve on the Federal Open Market Committee, the FOMC, from 2006 to 2011. And he was known to dissent against efforts to lower rates. So he is not a dove. He's not a monetary policy dove. And I think the bond market might be trying to tell us that we should not expect a whole lot in the way of future Fed cuts right now. I'll be interested to see to what extent they pursue a strategy that's aimed at lowering longer-term rates, which again would have a more direct impact on the real economy because it would affect mortgages and small business lending. But this right here, we're looking at commodities. This could potentially be a fly in the ointment for the Fed. So the Bloomberg Commodities Index, after a significant run-up post-COVID, the commodity space, it spent the last 3 years or so just going sideways, just grinding sideways. But we noted, however, a few months back that the asset class had shifted and had actually started into a new uptrend, right? And furthermore, it was breaking out above those former highs that had kept it range bound since 2023. Same story as we saw with the international stocks and the small caps and now the emerging markets, right? We would expect that once we eclipse those former highs, that there is room to run. And our eyes don't lie, right? That is quite a move that it has had since taking out those former highs. And it's largely attributed to what's happened in the precious metal space with gold and silver. Energy, oil and gasoline, it hasn't even really started to get moving yet. Crude oil is still in the mid $60 per barrel range. So all this to say, if commodity prices continue to advance like this, it's likely going to be a significant tailwind for inflation. And if the rate of inflation is not falling, that's going to put a damper on what the Fed can do with rates. I don't really care who's in charge. And I think that the message that we're getting from the bond market today is reinforcing that. So here's the last thing I'll say about commodities. There was a study very recently that was done that was talking about the amount that investors are exposed to the commodity space. And they were looking at asset flows into funds and ETFs. And it's estimated that investor exposure to commodities right now as an asset class is at a historic low. And so we at Reveille are firm believers in maintaining a disciplined asset allocation for our clients. And we believe that allocations to commodities are not only important, but while they're in uptrends, they are 100% warranted. We're going to end here this part of the presentation looking at real estate investment trusts, the Dow Jones REIT Index. It is still kind of trendless, just kind of grinding sideways. Maybe it's starting to try to put in a little bit of an uptrend there, but not a ton positive to say about this space at the moment. Not a lot negative either, but still just a lot of uncertainty here in the REIT space. So that is it for our big picture overview. So if you're watching this public version on YouTube, this is where our review is going to conclude. For our clients, this review continues, and we highlight the holdings that we currently own within our managed strategies. If you're interested in learning more about the strategies that we're managing, send us an email, info@reveillewealth.com, and we'll follow up with you. For now, I'm going to pass it back to Chad for a recap, and then I'll leave us with some final thoughts. Chad?
Thanks, Stephen, for walking us through this month's review. Now to recap. Global equity markets started 2026 on a strong note, with gains further broadening out across many sectors. A pronounced rotation from former market leadership is evident and has been strengthening of late. We note that the Mag 7 stocks that have dominated the market over the past couple years are unchanged since late October of last year. January exhibited strength in small and mid-cap stocks, value-oriented stocks, dividend payers, and we saw continued relative strength from international stocks. Extremes in the concentration of ownership and valuation levels in large-cap U.S. growth stocks continue to present both risks and opportunities, dictating the need for adapting to a changing market environment. Private credit problems persist, with further evidence recently building that dangers lay beneath the surface and must be heeded. President Trump has nominated Kevin Warsh to succeed Jerome Powell as the Federal Reserve Chair, thus removing an uncertainty that has been overhanging the market. And lastly, while the market environment has been constructive with longer-term uptrends remaining in place, we do caution that the road ahead this year may be a bit more volatile as we are in a midterm election and numerous geopolitical risks still remain in the market environment. So we will continue to use our rules-based investment discipline to help us navigate any kind of changes that occur in the market environment and adapt accordingly. With that, I'll turn it over to Stephen for some final thoughts.
All right, thanks so much. We appreciate everybody joining us here this month for the January review. Hope you found it insightful. It's been a really good start to this year. Need to make sure that we have our expectations tempered. Not every month is going to be quite as robust as what we saw in the month of January. But there's some good trends out there. We'll make sure that we continue to be aligned with them. As always, if you have any questions, please feel free to reach out to your advisor, or you can send us an email here to info@reveillewealth.com. Everybody take care, and we will see you next month right here.